And on that note, it is indeed an honor for me to now call upon, as our guest of honor, Dr. Patnaik, who's of course a distinguished economist and a financial strategist with over 2 decades plus of experience in the Indian capital market. Currently serving as the chief economist at the National Stock Exchange of India, he has expertise in macroeconomics and sectoral strategies, quantitative finance and consumer banking as well. Dr. Patnaik began his career as a researcher at the Indira Gandhi Institute of Development Research, and he later transitioned to consumer banking analytics, working as an analyst with the Citibank's Global Consumer Group in both India as well as Europe. His subsequent roles in equity strategy included positions as the India equity strategist at the Citigroup Global Markets and as the India strategist and chief economist at Religare Capital Markets as well. It's indeed an honor to call him on stage to address this humble gathering. Let's call upon none other than Mr. Tirtharankar Patnaik, the chief economist of NSE. Let's give him a warm round of applause as we invite him. Yes, Dr. Patnaik, we were humbled to be a part with you last year as well and hearing your presentation. So we look forward to his key intakes. Yes.
So while they load it, first of all, my apologies to Mr. Jha. Sorry, sir. Dr. Marpadi has been gracious enough. I have some other commitments for which I had to leave early. So the topic of my presentation today, you've read household equity wealth in India. I'm going to talk about, as the presenter and compare has graciously told, that I work with the National Stock Exchange. So I want to talk to you about what is happening with the markets. Of course, all of us know what's happening with the markets. There's nothing for me to enlighten this audience about. But I'm going to talk about what people like you and me are basically doing in the markets. And given our vantage position at the National Stock Exchange, we have about 93, 94% market share in the in the cash segment. So we've been doing some analysis on retail investments, and I'm going to talk to you and place some facts with you, and I'm going to also compare how we've been doing versus other countries. All of us also know that while Indian markets have done well, US markets have done quite well as well. So last year they were up 20%, while we were just up 9%. So here goes. I'm just going to set the stage this way, please. We see both the articles these days. On one side, we see that we've got 10 crore investors. By the way, yesterday you would have seen the headlines. The number of investors has crossed 11 crores. Just to set that in context with you, we have 140 plus crore people in this country. All right, and we have people in our age group, in the working age group, of about 640 million. So about 64 crore working age people are there in this country. And about 89 crore of us have bank accounts today. Okay, and in terms of markets, in terms of accounts, when you see mutual funds, we have roughly 5 crore. I'm not talking about folios here. I'm talking about unique people, unique individuals who have mutual fund folios. That's about 5 crores as per AMFI numbers, but that's also rising. For unique investors, the number is about 10 crores. And as I said just now, yesterday it crossed 11 crores. So we've been rising very, very fast. And you will be surprised, pre-pandemic, this number was around 2.7 crores. So the sheer number of people who have been coming to the markets has been rising. This is not just performance of the markets, but I'm talking about people, new people who are coming to the markets. For better or worse, I'm going to talk about that. And their activities. What exactly are we doing here? What kind of risks, what kind of returns are they seeing? Versus the other side, people have also come in the derivative market. And we have the SEBI report which says that about 90% of people who come into the derivatives market lose money. So both sides of the story are here. And let's go into this in slightly greater detail. The only possibility of coming to the markets is not just the allure of returns, because the allure of returns is in various places, in digital currencies, in online gaming, in so many places. what we are going to talk about here is investments and how investments lead finally back to wealth. And because that's the point of this, our conversation after all. So all this can only happen if you have a very, very strong regulatory framework. And I'm not going to go through each one of them here, but some of the points that are in front of you to see what has been done to ensure that the regulatory framework remains strong. After all, the very first goal of the regulator SEBI is investor protection. So various things are happening here. And what exactly and why, as an economist, am I interested in retail participation? Not as an individual, of course, I'm interested in my wealth rising, just like you all are. But for the economy, what's the idea? The idea is this, ladies and gentlemen. When you channelize savings, and by the way, the vast majority of Indian household savings go to banks today. I mean, about 40 years back, there were not much savings anyway, but when they did, they basically went below the pillow. People just saved money wherever they could. Then came gold. People started saving saving in gold, gold jewelry. Indians, as you know, own over $1 trillion of gold jewelry. The annual consumption of gold in India is about 800 plus tons. Only recently, in the last few years, we have been upstaged by China. Otherwise, Indians were the largest consumers of gold for decades. And so what's changing now? Some of the other things are happening. When you look at equity markets or equity market investments, this is where things come to. When you buy gold, gold stays with yourself. It's a store of value. It is there for you for a rainy day, for other various eventualities or milestones in your life. But when you invest here, either directly or indirectly, one part is it connects you with the economy. After all, if the economy doesn't grow, companies don't do well, your savings don't grow. It also reconnects capital markets with households. I've also given some research papers here, not for this audience maybe, but this has been well founded and well established, not just heuristics that we see as experience in our lives, but academically proven as well. And not just in India, but in economies across the world. So, households, when they invest in equities, they connect with the capital markets. It also affects long-term financial well-being of the people. And for the markets, it provides capital for growth. Many of you, we know that, the Indian economy is a bank-sponsored economy. The vast majority of savings go to banks, and the vast majority of flow of funds to the commercial sector comes from banks. If you see the RBI Financial Stability Report, last year, this number was around 35 lakh crores. Out of that 35 lakh crores, about 25 came from the banking system. And banking system, how? You take credit from banks, or NBFCs borrow from banks and again for on lending to the people. So that number was about 25 crores. But about 7 lakh crores, the 7 lakh crores also came from non-banking channels. And in there, about 5 lakh came from markets. And what am I talking here? I'm talking about equity IPOs, OFSs, and also bonds, corporate bonds. So several ways. And by the way, we are not unique. So in Europe, most of the economies are bank funded. Go back to East Asia, most economies are bank funded. But when you go west, say towards the US or UK or Canada, the majority of funding happens through markets. Corporate bonds are big kind of there. But I'll go back to my point. So this is how investments in the markets affects the economy. And as an economist, I'm also interested in that overall big picture. And now I'm going to talk about a little bit about Indian retail investors. Who exactly are we? And to use a oft known now comment, all of you must have heard about Jolly LLB or seen the movie. There's a famous dialogue there, "Kaun hai ye log? Kahan se aaye hain?" So that's the kind of further demographic identification that we are trying to do here. We have about 11 crore people who are invested in the markets. About 36% of them are from the north. These are the states which are traditionally the mainstays of investment in the economy. This gives you kind of two pictures. One, where investors are generally there from our markets. And secondly, the scope that's actually there. So I, for instance, come from Orissa, and there's hardly much investment into the markets in that part of the world. Not zero, but nothing like here as well. Another story here is Maharashtra has been always the state where you're in. It contributes about 15-16% of India's GDP. So Maharashtra, obviously contributes the highest number of investors as well. Gujarat has been the second player for a very, very long time, as far as at least we have records. But what has happened, and this is one of the many changes that we've seen in the markets in the last 5 years, is that UP, which trailed behind Gujarat in as far as back 2010, 11, 12, has now leapfrogged and become the second state to cross 1 crore investors. I just would like to point out here, I'm not talking about the multiple demat accounts that you will have. The identification of an investor to the regulator, to the markets, is through our PAN. You generally cannot have 2 PANs, right? So when we count PANs, and that's when you see that UP has now become the second state to cross 1 crore investors. And by the way, the pace of growth is higher in UP and Maharashtra than Gujarat at this point. So the other states which bring up the top 5 are Rajasthan, again very interesting, and West Bengal. West Bengal, again, it contributes a big chunk of Indian investors. And the other states, of course, you don't see any southern state here, any of the Karnataka, Tamil Nadu, industrialized states, but they don't come in the top 5 as yet. The other point that I wanted to say was the vast majority of investors today are not in my group, in my cohort of 40 plus people. They are less than 40 years of age. In fact, I'll talk a little bit more about this later. And females, generally market investments are seen as a male preserve. Not so much. You just see about 24% of investors today are females, but you will see in a separate slide as to what is the growth of females in our markets today. And that's here. Look at the bottom right. I've already told you this. I've shared some thoughts about this. The NSE is now 30 years old, 94. It is not the oldest exchange in the country. BSE has been there since 1870s. And we have the proud honor of having an exchange from India being the oldest exchange in Asia. So markets are not new to India, ladies and gentlemen. But I'm talking about NSE here, and NSE took 14 years to get the first crore investors. All of us know that India has about 140 plus crore people. We also know that India's GDP is about 320 lakh crores. But for the longest part of my career in investment banking, corporate banking and all, there were about 2 crore investors in India. 2% of India had access to the markets directly, indirectly. So the first crore took 14 years. That's 94 to 2008. The second crore took about 7 years. And as you can see, there is geometric progression going forward. And this geometric progression, as you know, cannot continue. Nothing continues like that. But until now, in February last year, we had 9 crore investors. In August, 10 crore. And yesterday, we got 11 crore people. So it's taking about 5 months to get a crore investors. That translates to roughly 75 to 80,000 every day. These are new investors that are coming to the markets. The question is, are they making money? Will they make money? What's the thought process there as well? But before I go there, let me just show one other aspect. I told you 1/4 of our investors are women. Okay, but the pace of growth of women in the markets is roughly 7 times that of men. Let that sink in. The pace of growth of women coming to the markets is 7 times that of men. As it is, we are adding 75, 80,000 people a day. And in this, there are far more women, relatively speaking, proportionally speaking, coming to the markets. And again, the age of investors, this is average age, pre-pandemic, 41 years, post-pandemic, 35 years, median age is 32 years. That has its own implications. 72% of our investors are less than 30 years of age. The vast majority of our investors have never seen a bear market. Indian markets have been up for the last 9 consecutive years. The pace has slackened a bit. Last year it was 9%. 9% is not bad, but given the pace of the previous few years, 9%. So in the last 10 years, 9 years have been positive. So people who have come to the markets, they generally just expect markets can only go one way. But as this audience, I can imagine this cohort will understand, that's never the story. Which pins are contributing to investors? These are some of the pins, ladies and gentlemen. Aurangabad in Maharashtra, Surat in Gujarat, Northeast Delhi, Northwest Delhi, West Delhi. So Delhi NCR is one region where UP is also seeing a huge number of investors. And but let me talk about the other side. States beyond the top 10 today are about 27% of the investor base. That was just about 23%. So growth is not just in the top states. Growth is also happening all over the country. And what I'm showing you here are some other numbers. So what we generally see are demat accounts. You can have more than one demat account with you. And the number of demat account is roughly about 17, 18 crore today. The number of trading accounts in the country is about 21 crore. But unique investors, 11 crore today. And what is that leading to? This is coming back to my bigger question here about household equity and household wealth. You see, if you are putting money into markets, does that money go out of the banking system? Many people think yes. Answer is no, it doesn't. Standard economics will tell you when you are investing, the money flow remains in the banking system. But the composition of those savings starts changing. So money which typically was in CASA, current accounts, savings accounts, would start now going towards more instruments which are much more linked to the term structure, say time deposits or even liquid funds. So what's happening is the share of investors, individuals who are in outstanding term deposits, notice that number is sort of going down. This is a supplement where investors or households are looking for non-fixed income based assets for their savings. And what has that led to? Some of the other things. Where are they putting their money? You see SIP flows. So quarterly SIP flows are about 80,000 crores. Monthly SIP number is about 25,000 crores. This is serious money. 25,000 crores on a monthly basis is serious money. What is more interesting, what is really interesting is the average SIP size is 2,000 rupees. Very low. So it's a number of people who are coming to the markets. I'll speak about the Pareto principle. All of us may be familiar, but let me just reiterate it for everybody. 20% of measures, 80% of measures lead to about 20% of the, 80% of measures or 20% of measures. So basically measures to outcome, okay? 20% of measures lead to almost 80% of the outcomes. That's the story. And what you're going to see here, the Pareto principle is a specific case of what in science is called the power law. And you will see certain things. The geometric progression that I showed you a few slides back of how investors in India have started increasing. And by the way, this is not just investors. You see very similar structures in how India took up 3G, in how India took up 4G, and now how India took up 5G. In every case, in each of the three cases, we were the fastest in the world, faster than the US, faster than China. Others are too small. I'm not talking about them. And what are the other sort of implications? Individual investors, not through mutual funds. Individual investors directly through the market have been net buyers in the last 5 years. Further, when they are not investing directly, when they are investing indirectly, they are also liking passive funds now. So about 20% of our assets under management are with passive funds today. I will just spend a little bit here before I talk about ownership, before I talk about the wealth effect that we are having. So I mentioned that we are 140, 145 crore people. Our economy, if you see the budget documents, is about 320 lakh crores, 325 lakh crores to be precise for FY25. And we all generally know the growth number, 6.5% is what the RBI tells us. But let me talk about the value number as well, 325 lakh crores. How big is the market? The market, before correction started in September, was north of 450 lakh crores. So first of all, the market is bigger than the economy. Remember this, the market is a stock figure. Those in accounting will understand. The GDP is a flow figure. Okay? It's what you earn as a nation in the year. But it's a good comparison. Generally, GDP is a good comparison. You talk about credit GDP, you talk about market to GDP and so forth. Now, the markets today are about 420, 430 lakh crores. I'm going to show you here how they have been in the last few years, 20 years to be precise, 2 decades, and also what's the composition of our markets. So, ladies and gentlemen, you and I, as households, own about 9.6% of the market. 9.6%. What exactly is 9.6%? 9.6%, if I round it off to 10%, of 440 lakh crores is 44 lakh crores. That's 44 lakh crores of investor wealth that's there with Indian households today. 44 lakh crores is 44 followed by 12 zeros. 44 lakh crores is marginally smaller than what the Indian government spent last year in its budget. The budget balance sheet will be available to you a week later from now. The number will be north of 50 odd lakh crores. Last year's number was about 48 lakh crores. So just to let that sink in, the wealth that we have as households, remember my topic was household wealth in India, with equities directly is about 44, 45 lakh crore. But we are not done here. You see mutual funds, look at that. DMFs, that's another 9.5%. Now, who owns mutual funds? It turns out that about 80 to 85% of mutual funds are owned by individuals. And to be precise here, I'm not talking about debt mutual funds. I'm talking about equity mutual funds because this is the market after all. And when you see that, and when you add that, that's my first bullet. Indian households as non-promoters. We are not talking about people who own companies. Of course, their numbers will be very much larger. That's there. Private Indian promoters own about 33% of the Indian markets. I'm not talking about them. I'm talking about people like households here. Unless there are promoters here, my apologies to them. So, if you add up our wealth directly and our wealth indirectly as non-promoters in equity markets, that comes to about 17.6%. 17.6% of 440 lakh crores. I will let you do the math. That's a big number. In a few years, this will touch 100 lakh crores. 100 lakh crores of investor wealth that's sitting in our markets today. 11 crore people owning about 100 lakh crores. Yes, not everybody gets equal share. As we all know in this country, there is a huge power law operating here. Some people have a disproportionate, a huge share of that, that wealth, but this is a big number. And the other thing is, let's compare it with our familiar friends here, the FPIs. So FPIs today, foreign portfolio investors, not promoters again, they own about 17.1% or 18%. Very close. Just the difference is about 7 basis points. However, in FY21, this gap was 7%. So let me say this clearly. Indian non-promoter ownership of our markets used to be 7 percentage points lower than foreign non-promoter ownership of our markets. Today, it is neck and neck. Why do you think, despite all the FPI selling, our markets have not collapsed? Just to give you some numbers here, September, October saw bigger selling in FPIs than in the COVID pandemic. In the COVID pandemic, the markets hit a downward circuit. We are nowhere close to that. Okay? And let me explain it the other way now. So there are 2,500 odd companies, and there are many investors. The idea is not just how much wealth they have, of roughly 80-90 lakh crores today, but our companies, the idea of investing in a company is to take part in its growth trajectory, in its growth story. There are several companies on the NSE, for instance, that have now touched 25 years of being listed. Okay? And long-term investment in such a company, I don't know, I will not tell you which companies, that's only our that's part of the investing process, leads to being a part of that company's growth process. In India, in 2014, there were 7 companies that had 1 million investors, 10 lakh investors. Today, that number is 55. And this is a familiar challenge I put out to people. You can Google how many investors does Google have or Alphabet have, whenever you get free time, or check it with Microsoft or so. Any of the big companies that we know of, NVIDIA, just see, and how many investors do our companies have. The point I'm trying to make is that our companies are taking a huge number of investors, a huge number of people alongside them who choose to invest with them for their growth story. And this is basically how that growth has happened. Over the last 14 years, this wealth has grown at an 18% CAGR. Now you might ask, this is not how the market has gone in, but this is how the investor wealth has increased in our markets. And I've just given you figures about promoter and non-promoter stuff here. Now let me just compare ourselves with the world. I've done India enough. I've shown you how household wealth in India has increased. By the way, some numbers again. In the last 1 year, in 2024, household equity wealth increased by 13 lakh crores. 13 lakh crores. I'm not interested in how much Nifty went up or not. No, that's a newspaper statistic. All of us are aware about it. I'm going to impress upon you a statement that we, as households, saw our wealth increase by about 13 lakh crores in the last 1 year. How do I do this? I simply take market size, market ownership, and market capitalization at the end of 2024. I compare it with what was it in 2023, and then I subtract net investments made in the year. Very simple. If I could be very precise, I would be doing it for each and every investor, but these are ballpark figures, 13 lakh crores. And if I add wealth since the pandemic, it's a marquee event for all of us all over the world, this number comes to about 43 lakh crores. And that's after the correction in the markets in September. 43 lakh crores is the increase that we have seen. Remember, my overall number was about 100 odd lakh crores. Now think about it. This is the kind of wealth people are sitting on today in the Indian markets. I'm just now going to compare with what's happening across the world. After all, let's have a picture across the world today. Indian markets are big. Indian per capita income, not so big. Indian economy, big. Indian economy is the 5th largest economy in the world. What's the rank of the Indian market? 4th largest in the world. Which are the markets larger than us? US. US is about 70% of the global market. US is about 30% of the global economy, but 70% of the global market. Second, China. Third, Japan. And fourth, that's us. We're bigger than the British markets. We're bigger than the German markets. Compare the other economies, we are far larger in terms of our markets. And in terms of households, I just gave you some numbers. I told you that about 18% of the markets is owned by households. But how many households in India have direct exposure or indirect exposure to the markets? That's 1 in 5. Let me put that again. 140 plus crore people. The Ministry of Family and Health and Family Welfare, they say that the average household size in India is 4. Hum do, hamare do. That's the idea we have. That gives us about 35 crore families. And I'm saying that 1 in 5 families have a direct or indirect connect with the markets. So the idea that the market is the unique preserve of urban people of a certain particular demographic is no longer true. We have investors from all over the country. When I say all over the country, I really mean all over the country. How do I say that? India has about 29 plus states. India has 700 districts. India has 19,300 pin codes. All but 30 of them have an investor. All but 30 of them. So 19,270 pin codes have investors today. So the idea again that markets are from one side of the country or certain people, no way, that's not true anymore. And we have this, why? Because India, thanks to our regulators, follows what is called segregation accounting. It's a part where we want to know who the investor is. Western countries, they generally look at what's called omnibus accounting. When you put your order, through a broker in the US, the exchange doesn't know who you are. That's omnibus accounting, but we have segregation accounting. And let's compare it with the world here. So one of the two things that happens here, typically, whenever you grow and become a matured market, direct investment in the market drops. So the share of households that own shares directly drops. The share of households that own shares indirectly through mutual funds, that increases. Look at what's happening here. The share of households that directly own shares across 20 years in some of the OECD countries, it's dropping. US 21% to 16%. Australia has collapsed from 37% of households to about 21%. But every other country, Germany, it was flat, it was very low to begin with. Germans generally didn't own shares directly. What's our number? Our number today, directly owned shares, is 1 in 5. We are at 20. Where were we 5 years back? We were at 7. So India is showing a different trajectory. Maybe because we are still a developing country. But here's the story. In contrast with many of the developed nations where direct investment goes down, indirect investment goes up, in India both are going up. So we have mutual fund sahi hai. As I'm sure you will see, the deck that was put up just before I did was mutual fund sahi hai. And mutual funds have done marvelously well. When I was in investment banking about 17, 18 years back, debt funds were 3 times equity funds. All of us know things have changed. Tables have turned now. So, but that's the story for India across the world. And the share of household, share of stock market value owned by individuals, US, king of the world, 40%. What's our number? 18%. We are getting there. We are getting there. It'll take time. And what has triggered? There are so many things. I'm sure I don't want to dwell on this. All of us know. But just to sort of underline the point, great infrastructure. India is the world's best country with digital public infrastructure. You simply don't get it anywhere else. Call it Aadhaar, call it UPI, the India stack. You see it in so many ways. It is bar none the best country. The peer-to-peer transactions between individuals, like me and Dr. Narendra, the kind of money that we can transfer, the ease with which we can transfer money today is not comparable anywhere else in the world. Indians today have about 45% of all real-time P2P transactions in the world. Sorry, that's not correct. It's 48%. 2023 numbers are 48%. And of course, these things work as well. And thank you. Thanks a lot. Thanks for hearing me.
So firstly, it's always great when you have Dr. Patnaik join us at an N-Cube collaboration event. Of course, his expertise and knowledge truly helps us to what lies ahead in the capital market and the personal finance space. I think let's give him a warmer round of applause for being the chief economist at NSE. And may we please request you to step in the center, and may I have the honor of calling upon Dr. Asha Bhandarkar to please join us and help us in our leaders' felicitation. Let's give our lady a warmer round of applause as we request her presence on the stage. So of course, just a small token of appreciation, Dr. Patnaik, for you from the team's side, and we just like both of them in one frame to give their congratulations to Dr. Patnaik, and of course, what a fabulous curation of content Dr. Patnaik always brings on the stage. So thank you so much for that. Thank you. Thank you. Thank you, ma'am.